Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for August 2025, proudly brought to you by Ainslie Wealth. I'd like to start by welcoming our panel today. We've got Joe and Drew. How are you both going?
Good, Chris. How are you?
I'm not too bad, Joe.
Yeah, good. Good to have Drew this month.
It is, yeah.
Give us
We're
his
mixing
cycle
it up a bit
updates.
this month.
Yeah.
Paul's off on vacation at the moment, so we thought we'd mix it up and get Drew's insights, and he's got a lot of insights to share, particularly around some of this cycle stuff. So, welcome. I'll
I'm,
just
I'm just going to ask Drew a few questions and just let him run. Just let him run with it. It'll be him talking
Yeah.
the whole time.
How many hours do you guys have? Because give me an hour
well,
per
yeah. I
question.
should have prefaced that. Once you start him on cycles, you can't stop him on cycles. That's the problem we have. Just before we begin, reminding everyone that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. All right, got that out of the way. Now, we will follow our usual format here. We sort of go through the big picture stuff first, then we dig into the Bitcoin cycle specifically, then the gold and silver cycles. And Drew loves to talk about the gold and silver cycle, so we'll spend a bit of time in there, and then we'll pull it all together with our simple trading plan, which has been doing exceptionally well. It's been an interesting couple of days, actually. Like we were just talking about this off camera about how the Bitcoin price is all over the place. Is it a buying opportunity or not? It's all over. It's all over the shop at the moment. You can see that really captured here in our cycles sort of overview chart. It seems like we have the global liquidity cycle increasing. That's something we've been following for a long time. We've had a bit of discussion this month about maybe the end is in sight, still off in the distance, but maybe in sight. We're still early on the macro cycle, which I'll talk to you about, Drew, in a second. But the Bitcoin cycle has flashed up a bear market signal, which is making it nice and confusing. Joe, start us off. If we look at starting with the macro cycle aspect of this, the first two, before we dig into the Bitcoin one, what's going on here with specifically that idea about where we are in the liquidity cycle? It seems like every month when I put this chart up, there's been a data revision of some sort. We can't really get much above that 50 line.
Yeah, absolutely. We've spoken a lot about where we thought the liquidity cycle would sort of end, and this one's definitely dragged out longer than we'd initially expected. That's for sure. But the fact that we're still in that early cycle, which is telling us that growth and inflation haven't started to rise significantly yet, which is obviously led by global liquidity, tells us that global liquidity is probably still got a bit to go. And we'll talk about that in regards to where liquidity is actually coming from. A lot of it's coming from developed economies. China and EM aren't really playing their role yet, and we think it has a lot to do with the dollar and potentially where US rates are going to head. So yeah, it's going to be an interesting discussion, that's for sure.
Yeah, there's a few elements that go into that, working out sort of where we are in those cycles. Drew, you've got an interesting perspective on this when we've been talking recently that, we've seen this early cycle and mid cycle that Joe's referring to there, chop and change back and forth. So the colors on this chart, the green and the blue, is it possible that we are in a bit of a flat to sideways cycle here that doesn't really have that spectacular takeoff in the liquidity that would see these dots really much higher on the chart?
The last cycle was quite a spectacular one, and I think there's certainly a bit of recency bias over there, where people are expecting a massive shoot up in liquidity. Now, just given the inflation backdrop, just hasn't been an option this time around, and you're not sort of seeing all of the central banks come to the table at the same time with a unified policy around the world, which also happened last time. So it has been stop start both for liquidity and the business cycle. As you can see on that chart there, we've been chopping back and forth between the blue and the green dots. And what's interesting about where we are right now is inflation coming back on the table in the short term almost seems quite unlikely, especially if you look at what's happened with the bond market's reaction to the Fed's forward guidance about rate cuts being quite likely moving forward. The bond yields actually dropped So, they're very much in agreement that inflation's not going to be a huge issue. We've got collateral values moving up, which wasn't the case when they started cutting interest rates last year in August. You had the bond yields actually shooting up, potentially pricing in a resurgence of inflation. So, look, if we're not seeing inflation coming on, if we're seeing choppy growth, if we're seeing unemployment numbers at pretty high levels, then yeah, we might just have a little bit of a lackluster cycle this time around. You might see this chop around between early to mid, and it's something that a lot of people are not considering, but we might even see a very short period of deflation or asset price deflation leading into the peak of this cycle, where the concerns of inflation might not be prevalent until the next liquidity cycle, which coming out of the 2026 lows, which are the cycle lows for Bitcoin, the half cycle lows for gold and silver. That QE that comes out of the environment of deflation and high unemployment will be quite spectacular, especially with Trump's got his hand-selected Fed chair finally playing ball with him. You could see a QE bomb that, in my opinion, it might even put what happened in the C19 era, in its place. It might even outdo all of that, and that's where you'd see a significant resurgence of inflation coming back in, and you'd see a lot of these signals play ball in a much more traditional sense. Now, just really quickly, that would obviously be a move out of the half cycle lows for precious metals and the cycle lows for Bitcoin, and a lot of commodities moving out of their cycle lows as well. So you should see quite a significant move coming out of that 2026 cycle low, which would work out in terms of a record amount of QE as well.
And that's such an interesting perspective looking at this chart, because the recency bias, I love that angle to say it doesn't always have to be this sort of spectacular and clear up to the highs, down to the lows angle. I mean, we'll talk about that a little bit more in a second, but I really do like that idea that sometimes it's just a bit of a sideways mess. And that's the period where I suppose you can get the most benefit from really understanding what's going on and why we have to dig further into more of our indicators and metrics to actually be able to interpret it, because it's not always crystal clear. It certainly was during that COVID move. It couldn't have been any clearer. It was almost a perfect sort of parabola. It made perfect sense. Joe, what is causing a little bit of confusion at the moment is certainly Bitcoin has performed very, very well. We couldn't have asked for a better run, really, throughout this liquidity cycle, even though the liquidity cycle has been choppy. But right here, right now, we're getting another one of those yellow candles indicating potential downside. Do we ignore it here? How do we interpret this against the backdrop of what Drew just said, against the backdrop of that other chart showing where we are in the cycle?
Yeah, that's always been sort of the challenge throughout this entire cycle. When we do see a bit of weakness in momentum in the Bitcoin price, we have to sort of come together and decide, well, do we think liquidity over the next couple of months is going to be going up, which will drive asset prices, or do we think we're at the end of the cycle? So obviously we've had quite a discussion yesterday in our investment committee meeting about where we think liquidity is going. We are reaching higher points in terms of developed economy liquidity. But we aren't really seeing that from emerging markets, which also include China, and who also play a major part in it. So from the perspective that not everyone is having that synchronized liquidity growth, as Drew pointed out earlier, we still think that there's room to the upside for liquidity growth as we go through the soft patch, which leads us to believe that any dips here are generally buying opportunities.
So let's dig into that a little bit more specifically around the liquidity cycle. We've got the big picture, we can sort of see where we're heading. But when you look at some of the specifics here, it has been, like we said, it's sort of just above that 50 line. But you do tend to find that these big cycle moves do end with a boom of some description, and certainly with a bust at the other end of that spectrum. Drew, looking at what you were just describing here, would it potentially be something more akin to the 2016, 2017 sort of boom there, where we might not get the highs that we have seen, sort of following on from that conversation before.
Yeah, absolutely. In more ways than one, this is looking quite similar to that 2016, 2017 cycle. But like you said, even looking at this chart here, there is still a decent amount of room to run. Even just comparing it to that cycle and comparing it to every other cycle, I mean, we're still not nearly at any reasonable peak. Now, even the 2016, 2017 did have a decent boom towards the end of it. And we were expecting a bit of an air pocket in liquidity coming into August and September, which is where we are right now. So, we'll see that on the next one or two charts, but you are looking at the rate of change curling over.
Yep.
And looking forward from here, there's plenty of reasons to conclude that there will be a decent boom in liquidity. So, whether you're looking at geopolitical events or some sort of resolution in the Eastern European regions looking quite likely, and then we've got rate cuts. So you've got, the Fed finally playing ball. But that final boom, I don't think should be a cause for complacency. It's quite important to be vigilant during that final boom, because that would be characteristic of that final phase of the cycle. And, even looking at rate cuts, I mean, we can dig into that a little bit further, but with rate cuts into weak economic environments, so you've got bad employment numbers that are constantly being revised, and you've got land cycles that are responding quite positively to rate cuts at the moment. But if the employment numbers continue to be weak, and if inflation actually continues down from here, like we have had a bit of a counter trend wobble in the inflation numbers, but the overall trend for inflation still is down. If that moves into a short period of deflation with high unemployment, while global liquidity is in its final boom phase, and you've got interest rate cuts on the table, it's quite it's a bullish environment in the short term for sure. But looking at the overall cycle, it's definitely a cause for concern. And if you look back at previous examples, especially leading into the GFC, of rate cuts, when they're cutting into weakness, the market tends to tolerate 2 or 3 rate cuts before putting in some sort of macro peak. So the 2007 cut started in June or July, and there was a peak in October. So if we've got rate cuts starting in September, a Q4 and at probably the latest a Q1 26 peak would not be out of the ordinary for this liquidity cycle. I do think they're cutting into weakness, and I think with the unemployment numbers, we can look back and basically say, they're constantly revising them down, and they're changing the way they even measure them moving forward. So in hindsight, perhaps we've been in a weak economic environment for a while now, and in most of the situations where you're cutting into weak economic indicators, you've got 2 or 3 rate cuts before a macro peak. So I would be looking at this with a little bit of caution.
Really interesting to say that around people being so optimistic at the moment around those rate cuts. They just see it as positive, and pointing out that it depends. It really does matter what the rate cuts are for. And in this case, if the rate cuts are coming on the back of weakness in the economy, that is fascinating, that you only get a couple in before the market goes, hang on a second, this isn't, bad news isn't good news here. People can go back and read, if they want to have a closer look at some of those previous cycles, what was unfolding there, and you can see that the future's still being written on what this cycle will actually look like when we look at it in retrospect. It always will look crystal clear. This is a zoomed in view with the sort of live monthly data. Joe, it's sort of poking its head above the 50 line there. Again, it's been chopping around that. Anything additional you would sort of add to what Drew has sort of said there around expectations that this isn't that beautiful? Like, you look at the previous cycle, it's just a perfect mountain. It doesn't have to be that, does it?
Yeah, and to Drew's point, every cycle has its challenges, and I think if you were going through, the 15, 16, 17 cycle, like, it's obviously very choppy, right? And then we moved into COVID, and during that period, you would have thought, well, there's no way that they're going to pump liquidity into such extreme levels that it's going to give us a nice clean bell curve, right? Which is exactly what we've got. And now we're moving back into somewhat of a choppy cycle with the expectation that it might have been the same as the last cycle. So it's really just about assessing all your data and all your tools and trying to figure out exactly where you are, because really there's no two cycles that are exactly the same. Even that choppy period through 15, 16, 17 was in an environment of low inflation where they're actually trying to cause inflation, whereas now we're going through a period where they're trying to officially subdue inflation. So yeah, every time we go through this cycle, that it has its challenges.
Joe, I'll stick with you on this chart. We just wanted, we've had a discussion recently about the M2 charts that are out there. You see a lot of them on X. You see a lot of analysts referring to the money supply and sort of equating that to global, or the M2 supply, sorry, and equating that to global liquidity. What we're looking at is a little bit deeper than that. Do you want to just give a little bit of an overview there? Because it is a question we're getting quite a bit at the moment because it is so prominent, those M2 charts.
Yeah, well, first of all, M2 charts are, that's quite an easily measurable number when you're talking about money in the economy and balance sheets of central banks. Like, you can find that stuff and pull it up on TradingView. It's all quite easy. And generally speaking, M2 is a good indicator of trend, but I would not be hanging your hat on every single move being tick for tick in terms of asset prices and M2, which I think a lot of people have been caught out recently, particularly with the M2 Bitcoin price chart, where it's starting to really diverge. And if it doesn't pick up quite significantly in the coming weeks, then that chart is going to look more and more like it doesn't work. So I'll just point that out first. Second of all, if you look at the way people generally measure M2 and how we measure global liquidity, there's about a $7 trillion gap, right? So that $70 trillion comes from collateral values, for example, bonds, which are used as collateral in the financial system and where money can be created to invest in financial assets. So you think about what impacts those collateral values is the underlying value of the bond, in terms of its nominal price and its price versus its duration, and also the volatility within that particular asset, because of the more volatile it is, the larger the haircut against when you want to borrow against it is. So all those things matter.
And we'll dig specifically into some of those topics in a minute, because they really form part of that deep dive on the macro economy. But it's so important to understand that what we're about to discuss when we get to the macro is the foundation of why this global liquidity index is more robust. And that is important when you get choppy periods like now that are going to be a little bit more difficult to read than they might have been in the past. Drew, when we look across, the heat map's always quite popular to look at across the world and see, well, I think it's pretty undeniable looking there that we're in a liquidity on environment, right? Like, the red is off in the past. What gets lost sometimes, though, looking at the world in that environment is, yes, we're lots of positive liquidity, but why is it so choppy then? It should be straight up. It should look like that other example, until you zoom in and look at the major world central banks. And when you look at those, they're really, I mean, that color, to me, that mix of colors is showing very much why it has been choppy and difficult to read.
Yeah, absolutely. And, specifically digging into the US and China, you can see how stop-start China's been, which, looking forward, again, then, might see another start on that side of things. And the US is now coming to the table as well. But really important to, sort of bring this back to, I think, what Joe was just saying as well, that there are so many factors into, the overall global liquidity. And that M2 chart, it does show the overall trend, but when you dig a little deeper, there's so many other factors, and it is a bit of a complicated metric overall to get an accurate representation. This certainly does help, but with the M2 specifically, at the start and at the end of the macro trend, it does break. And, people are saying it might not work this time, but you don't have to go too far back in history to see many occasions where it hasn't worked, this cycle included. So at the start of the liquidity cycle, we had a phase where M2 was going down, and Bitcoin was going up, but global liquidity as a whole was going up. And so, you can see that at the peak of the previous cycle as well, where M2 just continued up and Bitcoin had already peaked. So important to take an overall view. And yeah, here, not sure that we're going to see exactly what we saw at the peak of the previous cycle. But we'll have to just sort of take it one day at a time, because those things can change pretty quickly.
It's certainly an interesting chart. Looking at that bottom line, the aggregate across those majors just not getting a dark green, and certainly not getting a run of dark green like we did see in that previous cycle. It's quite telling, really, and makes a lot of sense against the backdrop of what we've been discussing. What people probably do need to understand as well is that the global liquidity number still keeps going up. What we're talking about with a lot of those metrics is the rate of change. Because if you look at this chart, you'd be going, well, clearly there's a lot more liquidity in the world than existed a year ago. Joe, Drew mentioned before about the potential air pocket. I think you've mentioned it as well in the August, September sort of timeframe. If we're looking at what that might look like on this chart, there's a fair way it could fall and we'd still be ahead in terms of nominal dollar liquidity to what we were a year ago.
Yeah, for sure. Like that chart tells a story. Like we're not exactly falling off a cliff in global liquidity, and if we did start to see that with elevated asset prices, we would be switching to bearish very, very quickly. But to your point as well, the rate of change of global liquidity is also very important because rate of change is basically the rate in which new liquidity is obviously being created. Our chart, I don't know, is that the next chart you got there in your pack? The rate of change one?
We'll look at that later.
We'll get to it later. Yeah, so basically what it's saying is, and when we get there, we'll talk about it, is that based on a year ago, because we had such a large increase in in terms of rate of change a year ago, we need an exceptionally large amount of rate of change today to have that rate of change continue to go up. So we'll talk about it then, but yeah, that's why we did have a little bit of a cause for concern. Now, the fact that we're getting this bit of a pullback, particularly in Bitcoin, is quite promising, because if it had taken off while that rate of change was falling, we would have, as I said earlier, been very, very cautious and probably look to start selling into that Bitcoin strength.
Yes, and that would be one of the things that we're certainly looking out for, to be an indicator at the end of the cycle when it does behave a little bit erratically, where the enthusiasm gets ahead of itself. If we turn to the macro cycle, just to pull the other side of this together, Drew, if we look at the growth rates in the US, they have been slow. We've made the point in the past that really that's actually a positive thing. As long as it's close to that sort of 50 line, there's positivity there, because it means that there's not complacency, certainly from central banks and governments. They know they still have to inject liquidity into the system. They still have to keep funding government. They can't really pull back on anything because we haven't got rampant growth. How are you seeing this going forward? That indicator would certainly suggest that we're still sort of lackluster across services and manufacturing, but is it, do you see a big pickup coming? How are you viewing this at the moment in terms of growth?
Look, in the immediate, short to medium term, not seeing a huge pickup. This has sort of just been chopping around sideways, look, pretty much for this whole cycle. The leading indicator is pointing up. So yeah, we might see a little bit of a pickup, especially leading into the peak of this cycle. But I think any major expansion in both of those will probably happen into the next liquidity cycle, where we probably see a massive pickup from the 2026 lows, the business cycle picking up significantly, and inflation coming back on the table probably a couple of years down the track from there as well. But at the moment, in the short to medium term, look, I've got no reason to think that this just rockets up north in the next 3 months.
And in terms of that inflation aspect here, it's dead flat, really. I mean, you just mentioned that might be more of a next cycle story. That's actually interesting, an interesting way to look at it. Everything doesn't have to happen in the one cycle, does it? Like you might have that this cycle is known for effectively sideways, although still elevated inflation. Certainly, we seem to have heard from Powell that the 2% target, at least for now, is gone.
Yeah, the way he's, the way they're measuring unemployment and the way they're measuring inflation, or not the way they're measuring inflation, but the way they're targeting inflation has changed. So, look, I think they're still going to keep an eye on it, but they've certainly shifted their focus from inflation being the number one issue to unemployment is now their main focus. So, yeah, like you were saying, in terms of it not happening all in the same cycle, it's really quite interesting to see how these different cycles interplay. And, looking at a major low in 2026 for precious metals, for a half cycle low for precious metals. So, the cycle low is 2022, next cycle low is 2030. So, half cycle low in 2026, as well as a low for Bitcoin in 2026. And then a macro peak in the land cycle between 2024 to 2028, with the reasonable expectation that the land cycle continues longer than the average, which would be early 26. So looking for a later peak in the land cycle closer to that 2028 period. If you look at the half cycle low for precious metals in 2026, with the next major cycle low in 2030 for an 8-year cycle, a 2-year decline into that 2030 or a consolidation would make sense. So a run up into 2028 for the metals makes a lot of sense as well. And if you overlay that over the business cycle, and importantly, the Bitcoin cycle as well, if you're looking at a low for Bitcoin in 26 and the next low for Bitcoin in 2030, a peak sometime in 28 would be a left translated Bitcoin cycle. The reason I'm overlaying all of this is to basically paint a picture of how things don't have to all happen in that one cycle. So,
Yep.
That 2028 time frame is of a lot of interest for multiple reasons. Looking at a run up of precious metals into that time frame, looking at the latest possible peak for the land cycle into that time frame, which would be reasonable. And that would be the next liquidity cycle. So to get from a low in 26 to a peak in 28 would be a left translation. That means there'd be an incredible amount of QE and liquidity in a very short period of time, actually quite similar to the cycle that we had before during the C19 era. And in that environment, you'd see a lot of these business cycle metrics pick up very quickly, a lot of inflation numbers coming back on the table to be pretty high, probably even, hopefully not, but possibly even higher than what they were in the previous cycle. Now, the reason 2028 is an important year as well is because of a 7-year cycle called the Shemitah cycle. Now, this is an agricultural cycle. It's actually listed, it's described in the Old Testament of the Bible, where every 7 years they give the land rest to let it, rejuvenate before working it again for the next 6. And what's interesting about the 7-year cycle is that the Great Depression, the 1917 recession before that as well, which was European led, the dot-com peak, the GFC, as well as the 2021 peak, were all Shemitah cycle years. So that 7-year cycle is definitely of interest. Now, in the last 100 years, and you've got about 16 of them, 8 of them have been major cycle peaks. The remaining 8 have still been either slowdowns or significant economic events. But what's really interesting is every major cycle peak has been a Shemitah year in the last 100 years, and the next one is 2028. So that year is of significant interest for me because it's the peak of the land cycle. The latest possible peak for the land cycle. So we're in that time frame now. It would be a decent run up for precious metals into that time frame. It would be a left translation in the next 4-year cycle. So cyclically speaking, I think a lot of indicators that people are going to look for the peak of the cycle, they will show up early in the next 4-year Bitcoin cycle specifically. And I think a lot of people will essentially throw cycle theory out of the window and combine these two cycles, saying that that was actually the peak. This, intermediary peak that we had this year didn't align with enough factors. And, from a cycle theory point of view, you would still see them as two individual cycles. You'd see one right translated and you'd see one left translated for the peak. But the cycles are measured from low to low. So the point of all of the indicators that we're looking for a cycle peak, we might see a lot of them not show up for this cycle peak, but we might see, deflation instead of inflation. So you're not looking at a peak of a business cycle. you might see high unemployment. And then you see a left translated, exuberant, euphoric cycle on the next one. And that's where a lot of these indicators would come in. So, like I said, everything doesn't have to happen in the one cycle. There would be two individual cycles, but I think a lot of people will view these two cycles as one extended cycle.
That's very interesting, and it is an important backdrop for us being able to understand what's going to happen, like why we need to pay extra attention to this particular cycle, because I think the choppiness of this cycle and the difficulty of this cycle is going to be what is going to catch a lot of people out. Joe, I want to talk to you about manipulation, particularly in terms of the move index. It seems like we've got, and probably aligns with this concept that Drew's talking about of what this particular cycle's like. We seem to have a lot of manipulation going on behind the scenes to really suck the volatility out of the bond market. And if I flip to these bond market charts, the other way to look at this, you can see very clearly that bond yields have been, they look pretty manipulated to me, right? Like when you see what's going on and how they're behaving as opposed to how they've behaved historically. Do you think that the volatility and what's going on there adds to this idea that this particular cycle might be a bit muted because it doesn't have the excesses that we will see in the examples that Drew's talking about of what the next cycle might be, for example?
Yeah, like I'm relating it back to Drew's cycles. I'm not an expert on that, but like in terms of suppressed volatility, that generally leads to an explosion of volatility at some point, and it's pretty clear that the Treasury and Secretary Bessent and Trump's administration are aware that bond volatility has quite a large impact on asset prices. If you can withdraw, like we were talking about earlier, if you can withdraw a lot of that volatility and improve collateral values, a lot of money will generally flow into risk assets, which at the end of the day is a large source of taxable income and revenue for the TGA, right, the Treasury General Account. So if you can keep those asset prices up high and you have those income tax receipts coming in, then you don't need to issue as many bonds, and they've obviously figured that out.
So do you think that ultimately the explosion higher that could come out of the manipulation of trying to keep everything steady is that left translated cycle? But like hypothetically, right? This is that left translated cycle in the next cycle that Drew's talking about there, where you really get that blow off top, because that would align with all of this stuff coming unraveled, surely.
Yeah, and that's certainly a possibility. If the thing is like these sorts of lulls in volatility can go on for quite a period of time. So if it's aligning with something that Drew's seeing in 6, 12, 18 months, then it's possible that volatility can stay subdued for that period of time, particularly if that's what they're trying to achieve intentionally.
And potentially all the way out to the 2028 in that scenario.
Yeah,
absolutely.
Just to bring that back to the 18.6-year land cycle. So the previous peak was the GFC, and leading into the GFC, you had the move index trending down for a very extended period of time, and it got down to that 50-ish level. So to see this, we might not see that bond market tantrum in the peak of this 4-year cycle, but if you're seeing that in the left translation of the next 4-year cycle, or what would also align with the 18.6-year land cycle being a longer than average land cycle, into that late 2028 period, you could see the move index trend down, for multiple years into that time frame. And the bond market's looking extremely manipulated at the moment. So it'll be interesting to see how much yields actually roll over and how much rates actually do end up getting cut into that time frame. So yet to be seen. But leading into the GFC, we had rates held high and yields held high for a while. So it's whether the land cycle well and truly peaks in 2028 is yet to be seen. We'll sort of have to take it 1 month at a time. But yeah, the bond market, I think, is going to be a huge clue to that.
And I think all of this to me ties into this next chart, which, Joe, I want to sort of get your opinion on here, the US dollar, because everything you've just described, the volatility being reduced in the move index, and really all these other factors, even the little bit of potentially deflation, the slowing of the economy, all of that is actually perfect for conditions for more liquidity to keep coming. The one that could throw us off here is if the US dollar, well, two things. If the bond market did have that tantrum earlier than expected, that would throw a spanner in the works. But the other one would be if the US dollar were to strengthen significantly, because generally a weakening US dollar in this environment is very good for liquidity. How are you viewing that here, Joe? Is it that, I mean, certainly this is a Bob Lucas chart, and he's already called the four week in of the 26-week cycle that that's heading sort of lower. How are you viewing that? Do you think that really the dollar has no choice but to go lower here? Would it, if it really took off and was rising significantly higher, would that be completely unexpected to you? How are you viewing it?
Yeah, I think you got to sort of go through the reasons why it may move in one direction or the other. I can't really see a reason why it's in anyone's interest for it to move up at this point. Like technically, it may bounce around, or maybe potentially form maybe a little bit of a higher low there towards 100. But in terms of reasons for it to go down, well, we know that they want to inflate the debt rate. We know they want to run the economy hot. Jay Powers has come out and said that he's more focused on the labour market than he is on inflation. That was effectively his speech, which the market was not necessarily pricing in. And then you also, potentially, as Drew mentioned before, if they are focusing on the labour market and they're looking at, the BLS is actually looking at how they calculate the employment numbers. Well, this new way of calculating employment numbers may cause a 550,000 and 900,000 job loss revision in September. In which case, if you get that, then Trump's certainly going to be banging the table for rate cuts, and Powell, based on his sort of forward guidance, may turn his 25 basis point cut in September to a cut the next month as well, potentially, or even a 50. Like, I don't know, like that's pretty far out there, but in my mind, that's a reasonable reason for the dollar to potentially fall off a cliff.
And yeah, the flow-on consequences for risk assets, particularly in our case, Bitcoin, and also precious metals in that regard, would be to see them well and truly rocketing off to new highs, because that would be very liquidity positive.
Yeah, well, that's right, because our liquidity metrics are all measured in US dollars. So obviously, if the dollar weakens, then every other currency's value in US dollar is more, which drives liquidity higher.
So let's turn our focus specifically to Bitcoin. There's a few things we like to look at, really why we like to look at Bitcoin in particular. We know global liquidity is tied very closely to world wealth. I mean, you can see that very clearly there, that you've got sort of this wealth effect, that percentage changes in global liquidity directly impact how much wealth there is in the world. We've talked about many times in the past the fact that inflation is not the same as like the inflation numbers we see, or consumer price inflation is not the same as asset price inflation. We all know that houses have gone up many, many multiples faster than things like food, for example. So, some assets do better at capturing that than others, which is our argument for Bitcoin specifically. Gold and silver do very well as well on this chart, but we've shown this a few times now. Bitcoin has a multiple somewhere in the order of, I mean, you could pick a number anywhere there, but let's say 7 for argument's sake. We were talking to Jamie Coots recently about that, and he was suggesting 7 was about the multiple you would expect. So Bitcoin makes a lot of sense to be the one that we're tracking. Joe, you mentioned this chart before that we were heading to. There does seem to be a bit of a turn here in the rate of change of global liquidity. That's the thing we've been tracking. That's the thing that has that multiple. So it's caused a little bit of caution in our discussions to just say, well, at the moment, that seems to be rolling over that rate of change, and that has traditionally been where Bitcoin peaks. We're not concerned about that right here. We're paying attention, but we're not concerned about it because we think that chart, that the line of rate of change is actually going to return to going up. Is this because that is what we were effectively forecasting. We did think that there was going to be a bit of an air pocket. We did think it's reasonable that it was going to slow down. What's your view on that? Because certainly if you took it at face value, there's potential for a top there.
Yeah, I think, and we talk about rate of change, but we've also got to look at that nominal level of 7% year-over-year increase, right? So 7%, whilst yes, it does seem like a high number, it's not an extreme number. And based on where we think we are in the macro cycle, there is quite a bit of potential for that to obviously roll over, find a bottom, and then tick back up. So like I was saying before, if you look back exactly a year ago, July 2024, we had quite a steep increase in the rate of change. So for that to continue increasing where we are this year, it'd have to be even more liquidity on top of what we actually saw last year in terms of the rate of change. So I think, we are going through that soft period, which may end in the next couple of months, 2 to 3 months, and then we'll potentially see it roll over and pick up again. But also, to your point, last year we had that large run up in global liquidity at the end after the election, right? And at the same time, this chart was actually rolling over, which gave us a bit of cause for concern. And we saw that Bitcoin pulled all the way back to 75,000 because it just got ahead of itself. And that's sort of what we were saying at the start of the conversation where, well, liquidity is rolling over. If we saw Bitcoin go to 130, 140 grand, well, we're potentially in that same situation where Bitcoin's just too far ahead of itself.
But that important caveat that we don't think it's rolling over for the end of the cycle yet.
Yeah.
We think there's still one more leg higher. Well, reasonably, that would be our expectation, one more leg, but could be anything. But that at the moment, we're choosing to ignore this particular metric. Also pointing out that this metric isn't as good as what that index is with all those other aspects in it. This is a more simple measure, closer to the M2. It's not the M2 chart, but closer to that. So that would also... but it's certainly causing us some getting us focusing the mind.
Yeah,
and
sure.
if you,
Sorry, go on.
I was just going to say, if you think about what could sharply turn that to the upside, it's the dollar, right? If the dollar rolls over in the next, significantly over the next 6 to 8 weeks, then that's the rate of change in terms of dollar liquidity is going to start moving up very quickly. And that could be exactly what Drew's talking about in terms of that ending this particular cycle before moving into the next one.
Yeah, in terms of the dollar rolling over, that would be perfectly in line with rate cuts as well. So, like we mentioned, we did expect a bit of an air pocket coming into August this year. And like Joe pointed out, it did roll over last year around this time leading into the election as well. So that could change pretty quickly. And if we see, geopolitical resolution in Eastern Europe and we've got rate cuts and the dollar rolling over, a short turn and then a quick move back up would make a lot of sense for that rate of change coming into Q4 this year, so October, November, December. But I will just add, like you said, we are being more vigilant now at that final stage, and that explosion of global liquidity upwards would actually be something that gets us even more concerned and vigilant in terms of the timing of the overall cycle. So that's something that we haven't seen, that final explosion, and it would be reasonable to expect it in the next 3 or 4 months. But when that does happen, that's certainly a time to be paying very, very close attention.
And we can use this chart to do that a little bit. This is about a week old because we didn't have the updated data before recording. But obviously Bitcoin's come down from there, from the price it was, but we're still within the realm or the range you would expect. And what's probably more interesting is this 60-day cycle chart, again, that Bob Lucas work, that's suggesting that the high is probably in for this 60 days. It's certainly headed lower. It will look quite good updated today, where it's sort of down much closer to 110. Joe, if you look at that chart, it's all consistent with what we've been talking about, really, that timing wise, because remember, we don't really use this for a price as such. We're using it more as a timing mechanism. So that would be about where we would expect it to pick up again, probably, into or even post October.
Yeah, absolutely. Yeah, and we're probably in the midst of forming a low right now, to be honest, which would sort of align nice with what you're saying.
But it also, we wouldn't be surprised if it didn't break to new all-time highs until that next
No,
cycle.
no, exactly right. Like it's just a guide which we overlay with our other stuff. So
Looking really short term, Joe, I know you focus a lot on this particular chart. This would indicate, I just updated this morning, would indicate that really the move that we have seen, that we're starting to get the market positioning the opposite way, and that generally works against them. Yeah.
yeah, absolutely. You don't think it, if you look at the top there at 124 all the way down to just before the Jackson Hole meeting, it was just down, down, down. Like you're going to get these pops into liquidity areas along the way. Like it doesn't just, nothing just heads straight down in a straight line, right? So at some point we're going to retap those liquidity pockets above at about 114 there. And whether it breaks through, yet to be seen. But just important for people to remember that these things don't head in a straight line.
But that certainly would be the fuel to see a bit higher for this 60-day cycle we were talking about, but not necessarily all-time highs.
Yeah, well, yeah, because everyone, at this point in time, everyone's getting short. So, if you do see that pop back up to that 114, 113, wherever that indicator is at the moment, all of a sudden you get those shorts closing in and those positions being bought back, which gives you the fuel to push through back up to maybe, 118, 120 mark before you get a correction back down as everyone sort of gets along again.
Drew, we'll talk a little bit about gold and silver. It has been it's been a spectacular run really for gold. And you look at this chart, it's sort of stabilized a little bit at those highs. This chart is updated at the end of the month. So this is the end of July data. But when you look at it against global liquidity, it's certainly, it's done very well. It's the average data for the month as well, I should point out. Silver's done even better in percentage terms. It's just really been a very straight up and to the right sort of move. Something I know you look at quite a bit, and I know our audience is very interested in, is the GSR, or the gold silver ratio. When you look at where the metals are, probably a couple of questions here. Firstly, do you think that run needs a bit of a pullback from here? Is that consistent with everything else we've been talking about from the Bitcoin lens? Because they have both had just really spectacular runs, not suggesting they can't go further longer term, but do they need that short-term pullback? And sort of the follow-up for that would be, how would you play in the sort of short to medium term this gold silver ratio, because it is quite elevated. It's come down a bit since this, because this was updated at the end of the month. It's come down a bit with silver sort of outperforming a bit. Has silver had its run for now? How are you viewing it?
Yeah, in terms of a final run up of global liquidity into the end of this year, I think gold and silver are going to play ball with that, very much so. And as far as the gold to silver ratio goes, I do think that's going to continue trending down into any sort of macro peak. And then during the macro peak, we'll have a spike in the gold to silver ratio once again, as people sort of duck for cover and de-risk a little bit, looking for flight to safety assets. And gold tends to outperform any other growth asset in that period. Now, yeah, in the short to medium term, I actually think if you look at not only what silver's doing, but if you look at the miners and the junior miners for gold and silver, they're actually up and to the right. So they're very much leading the way in this next move. And the money that's flowing into those is essentially speaking, saying that they are expecting another move up for gold and silver. So yeah, I think leading into the end of this year, seeing a move up for Bitcoin, gold, and silver together would align quite nicely with the base case expectations, and seeing that GSR continue to roll over downwards into that peak would make a lot of sense as well.
So you might suggest that any sort of sideways move would be short-lived and probably aligned with that September, August, September air pocket as well.
Yeah, 100%. And look, personally, I wouldn't be switching too much between gold and silver for these shorter term moves. It's a very long term trade. So if you've got the GSR sitting at where it is right now, even if it drops 5 points, that's not necessarily a trade from silver into gold just yet. these cycles for the GSR, the gold to silver ratio, they do follow 20-year cycles, but there really is a larger 100-year cycle at play. And I think, it's the people that, bought Bitcoin 4 cycles or 3 cycles ago and just held for that macro move up, that have done the best. So with the GSR as well, it's a similar story. You're buying your silver when the GSR is well and truly above that long-term average of 50. And then looking at where we are in the final 20-year cycle of a macro 80-year cycle, you do see the GSR spend decades in that 60 to 90 region in the last 40 years of the 80-year cycle, and the first 40 years of the next 80-year cycle, which was previously after the Great Depression and World War II. The GSR spent multiple decades in that 20 to 40 region. So if we're finishing the 80-year cycle and we're in that final phase of that 80-year cycle, which again would align pretty well with that 2028 timeframe, and then you're entering the next 80-year cycle, so the first and the second turning, the next two 20-year cycles within that 80-year cycle. If you've got the GSR spending multiple decades in that 20 to 40 region, that's really the trade. So it is a much slower, longer-term view on silver.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell and swap gold, silver, platinum and crypto online or in our Brisbane, Melbourne and Gold Coast showrooms. With over 50 years of operation, we are a reliable partner in wealth management. Visit ainslie.com.au to find out more about Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Okay, now every month we do like to provide an update on our trading plan, which is a nice simple one, focused on Bitcoin specifically, where we really just trade the cycle, and we've identified what that is on this chart specifically. So we give that buy signal. It's just about buying and holding through that cycle, waiting for the sell signal. As we identified today, not a sell signal yet. The first sort of hints that we're getting towards the end of the cycle, but we haven't ticked all the criteria to be able to put that sell signal in. It really highlights how well you can do by just understanding these cycles and trading and just holding through them, because the current gain, 560%, this was as of the open of what was actually yesterday's candle, but that's 213% annualized, is just spectacular, right? There's no other asset class that has been able to predictably give you those sort of returns over that period of time. Will we be able to do it again in the next cycle? Well, who knows? But I mean, part of what's been pointed out here is the next one might actually be an easier one in some regards to predict and have bigger blow off tops and faster moves and all that sort of stuff. So for the time being, at least, if you've been following along for that whole time, you've done very well. And then it's about waiting and taking some of those chips off the table. Joe, we'll wrap up with our final thoughts. I'll start with you on this, but I just wanted something you've mentioned to me before when we were talking about this. It's been such a good run in Bitcoin there that even if there's a hint of a potential top being in, there's nothing wrong with taking a bit of profit, even though there can be still more available that has to stay on the table.
Well, exactly like the previous slide that you just pulled up. If you're anywhere in at the start of this cycle, whether it be 16,000, 20,000, or even 30,000, your gains are actually been quite substantial. Now, we do think we're closer to the end of the cycle than we are at the start. And if you were, for example, to take some profit here, I don't necessarily think it's the end of the cycle. But if you wanted to just sleep better at night, there's absolutely nothing wrong with that, because there's always going to be at some point another cycle low, right? The bull market will end, and it's going to be plenty of opportunity to buy back in. It's just at the end of the day, whatever helps you sleep at night. Plowing all your money in now because you don't think you've got enough exposure is probably not the most prudent thing to do. Like, you can still buy the dips, but going full bore here is maybe not exactly the greatest plan at this point.
I think I might follow that with my final thoughts on it, because it really follows that idea that we know we're towards the end of the cycle. We don't think we're at the end, but caution will increase from here. I think it's been very easy up until now. That was a conversation that we've all been having, is how easy it was through the years that have existed so far in this cycle, it becomes hard from here on in, because you have to really understand what those metrics are doing, what all those indicators and things that we're looking at are doing, to make sure that you do get that top. It's much easier actually at the bottom to pick the entry, because usually everything's exhausted, no one's interested. It's quite easy to get in. It's hard to get out. And I think I will be following some of your advice there and starting to look at opportunities to at least take a little bit of that profit off, because you don't need to be fully invested right through. We will a day will come where we will put that sell signal on there, and that will be our definitive end, saying that's the end of that trade. But there's nothing wrong with taking some of those chips off the table on the way up. I do agree with that, even if we do get significant gains to go. We're not saying necessarily even take all of it off, but taking some of it makes sense to me.
Yeah, and to clarify, like, I'm still net exposure, I'm quite long. Like, I'm still betting effectively on the market going up. I also feel that if you've got zero Bitcoin exposure over the long term, these dips like these are still a good buying opportunity, right? Like, it's just that's all I'm saying.
Yeah, and it will become. I mean, Ainslie Wealth is the fund that we're running Bitcoin and bullion, where we're using all of our expertise and additional expertise as well to really fine tune those entries and exits. What we're talking about here is more for the average person who's just in this going, what do I do? That the advice is, well, you've done very well if you've followed along. So, you don't need to squeeze every last part of that out. Leave that to the experts who are trying to manage that, because it gets much harder from here. It doesn't get easier, that's for sure. Drew, I'll leave you with the final words. What are your thoughts to wrap up this month?
Yeah, look, I think we've got a lot of great indicators on the table that are going to start flashing for that definitive sell signal. One point that I would just make is that as we get to this final phase, sentiment's really important, not just to keep an eye on as a contrarian indicator where you start seeing excessive amounts of greed and complacency amid market participants. That's a counter indicator, but also to for your own personal trading and investing. When you're getting to this final phase, as you've been sort of saying over and over again through this video, now is really a time for caution, and not a time for complacency. So getting into this final peak, we are more or less now hunting tops, and that's a multi-month process. But just to err on the side of caution, not get complacent, not over leverage, not get too greedy. And if you have no exposure, if you've got a very, very long-term view, like Joe said, averaging in is never a bad idea to a blue chip asset, but betting the family farm at this stage of the cycle is probably a little bit, a little bit of a bad idea in that sense. And yeah, we'll just continue tracking it one day at a time.
Look, it's probably been a slightly different tone here to what we've had really since we've started these videos, because as I said, it was easy. It was always just going up. We were quite confident in that. It becomes a little bit harder here, but that's the value of these videos and the value of us continuing to do them month after month, because that's where we'll be with you through that journey, particularly as it gets a bit more challenging towards the end. Not suggesting we're at the end yet. I think we've all made that quite clear, but we can see it off on the horizon. So we're starting to pay a little bit more attention to all of those metrics along the way. So look, thank you for watching our update for the month. Thank you, Joe. Thank you, Drew, for your contributions to the analysis today. Really appreciate that.
Thank you, Chris. Good to chat to you as always.
Yeah, thanks for having us. Thanks for coming on, Drew. It was great.
No, thanks, guys.
Yeah, it is. We'll definitely get you back. We'll get Paul back as well. He's off on holidays, but he will return. Look, I always value feedback and discussion, so follow me on X at Tipper Analytics to stay up to date or reach out. You can also leave comments in the YouTube area where this will be uploaded. Anywhere where you see us post this, we do read all those and we take that feedback on board if there's anything you want to see. So make sure you let us know. We'll be back in September with the next monthly update to reassess and identify what's changed. Until we chat again, good luck in the markets.